Hello everyone, welcome to my channel. Today I'm going to talk about May 5th resumption of federal student loan collections. Let's get into the video. As the US Department of Education charts a new path post-pandemic, one significant move is the resumption of federal student loan collections. This initiative, set to commence on May 5th, marks the end of a years-long hiatus in collections on defaulted loans that began in March 2020 due to the COVID-19 pandemic. I am going to take a look in this video at what this means for borrowers and the broader implications. The background and current landscape. Historically pause in collections. The federal government had paused the collection on student loans as a relief measure during the pandemic. This moratorium allowed borrowers some breathing room during an unprecedented economic downturn. However, the pause not only deferred repayment but resulted in a growing number of loans entering default, with numbers reaching concerning levels. The second thing is the current debt situation. As of now, approximately 42.7 million borrowers owe over 1.6 trillion in federal student loans. Among these, more than 5 million borrowers have defaulted, having missed payments for over 360 days, some for over 7 years. This has created a situation where a quarter of the federal loan portfolio could soon be in default. Resumption of collections. Mechanisms of collections. The collection will resume through the Treasury Offset Program, enabling involuntary collection actions such as withholding tax refunds and garnishing wages. The Department of Education, through its Office of Federal Student Aid, will also employ administrative wage garnishment, which can demand employers withhold up to 15% of a borrower's disposable income. Communication and enhanced efforts. The resumption of collections will be coupled with extensive outreach efforts. Borrowers will receive emails from FSA advising them on repayment options such as income-driven repayment or loan rehabilitation. Furthermore, over the next 2 months, the FSA plans to conduct a robust communications campaign aimed at boosting borrower awareness and engagement. Support and resources for borrowers. To ease the transition back into repayment, the Department of Education is enhancing support systems. Enhance income-driven repayment process. This process will streamline enrollment into IDR plans, eliminating the need for annual income recertification, which simplifies the borrower's experience. Outreach and partnerships. Collaborations with states, educational institutions, and other stakeholders will play a critical role in guiding borrowers back to repayment. Tools like the loan simulator and AI assistant Aiden are being introduced to assist borrowers in choosing the most suitable repayment plan. Implications and the road ahead. The decision to resume collection is seen as necessary to maintain financial responsibility among borrowers and avert potential taxpayer burden due to default loans. According to the department, resuming collections assignment assigns with effort to safeguard taxpayers and ensure that loans which were willingly undertaken are repaid. However, this move also underlines the need for a structured and compassionate approach to assist borrowers re-enter in payment, many of whom are emerging from the financial strain imposed by the pandemic. As the education sector continues to adapt, the focus remains on balancing fiscal responsibility with borrower support, preventing further financial crises while encouraging economic stability. This Fruley approach by the Department of Education reflects a significant shift towards reinstating financial order and ensuring a sustainable path forward for borrowers and the federal loan portfolio alike. Student loan interest tax deduction. Taxpayers who have not been paying their loans during the ISS may have forgotten that there is an above the line deduction, that is a deduction when figuring adjusted gross income, and available even if not itemizing deductions for interest payments due and paid on any qualified student loan, regardless of when a taxpayer first incurred the loan. A qualified student loan is generally one used to pay qualified higher education expenses, that is, tuition, room and board, and related expenses for attending post secondary educational institutions, including certain vocational schools and certain institutions offering postgraduate training. The maximum deduction per year is 2,500. This is per return limit, not a per student limit. However, the amount of the interest that is deductible is phased out for married taxpayers filing a joint return when the modified AGI is 170,000 to 200,000. For unmarried individual, the phase-out range is 85,000 to 100,000. When income exceeds the top of the phase-out range, no amount of the interest is deductible. No deduction is allowed for those using the married filing separately status. Lenders that receive $600 or more student loan interest during the year must file Form 1098E with the IRS. A copy of it or an acceptable substitute must be provided to the borrower. First, someone paying less than 600 of student loan interest per year may not receive a 1098E form, but may still be entitled to a student loan interest deduction if they have documentation of the amount paid. Thanks for watching this video, and do not forget to subscribe to my channel.